Welcome to Getting Your Shit Together. I'm Neil, a mortgage pro with nearly 5 years of experience.
And I'm Jerome, with over a decade of helping clients navigate mortgages and real estate. We are the co hosts of this podcast, and we are here to break down the financial stuff that people often feel overwhelming.
Whether it's mortgages, investments, or insurance, we simplify the complex so you can take control of your financial life.
Each week, we'll bring in experts like realtors, financial planners, investors, and more to give you insights into the actionable advice that we're providing.
We are here to bust myths, answer your burning questions, and help you make smarter decisions.
So if you're ready to get your shit together, listen up. We're here to help you.
Today, we are going to talk about how your current approach to using credit might need a serious rethink.
That's right, Neil. We're diving into a topic that's more relevant now than ever. During the COVID era, many of us got into a habit of using credit cards for everyday purchases, racking up reward points while we were at it, which was awesome. It made sense then. We were spending less overall, maybe even saving a bit. But now, with higher interest rates and inflation driving up the cost of everything, those same habits might be putting us in financial quicksand.
Exactly. And here's the thing. Continuing to use credit the way that we did, when money was flowing a little easier, could mean spending more than we are actually earning today. It's like borrowing from your future self, except future might not have the cash to cover it. We want to help you avoid that trap.
Let's break it down with a story about Johnny. Johnny got into the habit of using his credit card for everything back when he was saving money during the pandemic. It worked for him. He'd earn points, he'd pay off the balance every month. But now, with prices up and his savings down, he's still using that card the same way. And he's not able to pay it off each month anymore. What Johnny doesn't realize is that he's digging a financial rut. And if he doesn't change course soon, that rut could become a trench he can't climb out of.
That's a powerful image, Jerome. Johnny's story is more common than you'd think. The problem is, by the time people realize they are in over their heads, it's usually too late. They are forced to make drastic changes, often under the guidance of a trustee in bankruptcy. We are here to help you avoid that last resort scenario by recognizing the signs early and making adjustments before it's too late.
Absolutely. The key to change is your relationship with debt now rather than waiting until you're forced to. Look at your spending habits. Ask yourself, are you living beyond your means? And start thinking about ways to live within them. This is about taking control before your financial situation controls you.
So, what can you do today? I recommend start by taking a close look at your credit card or loan statements. See if you're carrying a balance month to month. If so, it's time to reassess how you're using credit. And remember, you don't have to figure this out alone. Professionals like Jerome and I are here to help you review your situation and find ways to get your finances back on track before they get out of control.
That's right, Neil. The biggest takeaway from today's episode is that small changes now can prevent bigger problems later. Don't wait until you're in that trench to ask for help. Reach out, get a second opinion, and let's work together to make sure your financial future is as bright as it can be.
So, Jerome, let's have a discussion about business owners or self employed persons and how they can use B lenders to their advantage. As you know, like a number of Canadians out there, I am a self employed person. I run my mortgage business under a corporation for various reasons. One of them is the flexibility that it offers, wherein I can choose to pay myself based on my financial needs. And I'm not forced to pay myself a higher salary just because my business is doing good. This helps me keep my taxable income lower and thereby reduce my tax burden. But there is a downside to this approach. If someone is self employed and run their business for a corporation, they would have experience that securing a mortgage through traditional lenders can feel like navigating a maze. Prime lenders, and you can think of big banks here, rely on personal income tax returns to assess income and determine the mortgage eligibility. They might look at your business financials, but that is just about to confirm that the business can support your income. Net result being, many self employed professionals and business owners who pay themselves a lower wage or share of profits in order to maximize business growth and tax efficiency suddenly feel disadvantaged. What is truly a smart strategy for their business and personal finances works against them when trying to get a mortgage. And that can be the cause of dilemma. Should business owners really have to take a higher salary and or dividends than they actually need in order to qualify a mortgage? And mind you, the bank wants to see a track record of this. And so they would consider a minimum of 2 tax years of personal income. So, Jerome, what should they do? Is there a way out?
Here's where the game changes, though: the alternate lender advantage. A beacon of opportunity for self employed professionals and business owners. Unlike prime lenders, alternate lenders often rely on your bank statements instead of your personal income tax returns to assess your financial situation. This approach allows you to maintain that lower taxable income while still qualifying for a mortgage with your actual financial capabilities. To put this into perspective, let's consider a case study. John is a professional with over a decade of experience. He transitioned from full-time employment to becoming a business owner, earning a solid income of over $230,000 a year before corporate taxes. So to optimize his business growth and tax efficiency, John pays himself a modest $90,000 salary annually, which is more than sufficient for his needs. What if Johnny wants to buy a property for $1 million and he needs a mortgage of $800,000? With a prime lender, or an A lender as many people like to refer to them, or a bank lender, he'd need to show a personal income of somewhere between $150,000 and $160,000 for the past 2 full years in order to qualify for that mortgage. But with an alternate lender, his personal income tax returns wouldn't even be considered, and he could continue to pay himself a slightly lower salary of $90,000 and still qualify for the mortgage. Isn't that really cool? So, Neil, can you elaborate a bit more into the financial benefits of this approach?
Sure, Jerome. Let's first talk about the tax advantage. With an income of $90,000, John's personal tax liability in Ontario would be somewhere around $18,500. But if he bumped his income to say $150,000, his tax bill could soar to over $42,000. And that's an additional $24,000 in taxes every year. Is there anyone who likes paying more tax than required? So clearly, going with a B lender has its tax advantage. It is also important, while we talk about advantages, to see as to what downside could be there to choosing an alternate lender, as there are some costs involved. Firstly, a slightly higher interest rate. This premium can vary anywhere between, say, 0.75% to 1.5% based on circumstances. Also, there is the 1% fee for the mortgage itself. But the good part is that these costs might still be low enough to offset the advantage of the lower personal income tax. One would need to consult a mortgage agent or broker for sure to see as to how it might affect you personally. And so it needs some further analysis. But going back to the example of John, the slightly higher interest cost from an alternate lender could result in, say, about $11,750 in higher interest and fees per year. However, this figure is still much lower than the 24,000 in additional tax that he would have to pay each year if choosing a prime lender or a big bank instead. That's quite a bit of savings.
So, should all business owners use a B lender in all circumstances? Are you able to provide a general recommendation?
That's a great question. So let me elaborate. A review of specific personal circumstances is always required to answer this appropriately. However, generally speaking, this is what I would recommend. This strategy of using a B lender is best suited when a self-employed person is buying their owner-occupied property or even investment properties. So so I would say for all purchase transactions, maybe that's an option to go with. However, one would need to be selective when it comes to subsequent renewal or a refinance. If the idea is to keep the property for long and not frequently pull equity out or extend the amortization, I will recommend planning out an approach where you move the mortgage to a prime lender on the maturity of the first term. But if the idea is to frequently access equity for investment purposes, then retaining at a B lender might be more appropriate. In a nutshell, this requires more forward thinking and planning in order to achieve an optimal financial outcome. Hope this helps.
It does, Neil. Thank you for sharing that. In conclusion, if you're self-employed and or a business owner, don't let traditional lending criteria hold you back from looking at your financing options. Alternate lenders have a gateway to mortgage opportunities that may align better with your true financial picture. And with the right mortgage broker by your side, that can make smart decisions that support both your real estate goals and your financial health. So let me ask a question. Attention to all self-employed professionals and business owners. Have you ever considered using a B lender or an alternate lender for your mortgage? We'd love to hear what your experience was, whether you decided to go for it or opted not to. What influenced that decision? Clickety-clack in the notes, let us know.
Thanks for tuning in to Getting Your Shit Together. We hope you found today's conversation valuable, and we look forward to bringing you more insights in our next episode. Remember, the sooner you get your shit together, the better off you will be.